Well, it's great to have you with us. And as they celebrate July 4th, we've been talking about this record run-up in the stock market, despite the fact that there's plenty of geopolitical risks. And, of course, we're continuing to monitor fiscal uncertainty, both in the United States and in Canada. How are central banks going to navigate that? Remember, we had a jobs report in the U.S. this week that had some bond traders thinking that maybe the U.S. Federal Reserve is in no rush to cut interest rates, but will the bond market speak loudly if it feels like an avalanche of uncertainty is worthy of your investing attention, especially with the stock market at all-time highs? Let's ask Earl Davis, who's head of fixed income and money markets at BMO Global Asset Management and one of our regular guests. And Earl, it's nice to see you.
Always a pleasure to be here.
I was saying earlier this morning, I like these quieter days because, for the subset of investors who are long-term planners and thinkers, which is it's a large cohort, you don't have a lot of moments to breathe. But we've had this year where investor enthusiasm in equities has been strong, and yet you have this laundry list of uncertainties in the air. And I would say that, the bond market at the end of the day is kind of the place we check in on when it feels like there's a need to get a signal of what's happening next. What's happening in your world right now?
Yeah, so what's interesting in our world, bond yields have rallied. We've seen it both in the U.S. and Canada over the past 2 months, and a lot of that was off of speak about an easier Fed coming in. The change of the Fed governor in the U.S. Next year, the mandate comes over. The allusions from President Trump on, rates need to be a lot lower. The market has taken hold of that in regards to buying bonds and foreseeing lower yields. Do we believe that where yields are sustainable? I would say we foresee yields going higher, but not now. And the reason why not now, the market only focuses on one thing at a time. And right now, the big headline, obviously, is the new bill, the BBB, that has passed in the U.S. And the way we look at that, that's almost like a shot of adrenaline to the economy. Less taxes means more money in the economy, more military spending. It's a shot of adrenaline. So we can foresee over the next 3 months the economy doing pretty well. And I'll touch upon something for Canada as well. I'm actually using for the first time in years the word optimistic on the Canadian economy, and we'll come back to that afterwards. But to your point, will the bond yields go higher? Yes, we do see bond yields going higher, but not until the end of the year. And the big catalyst for that, bond yields going higher in Canada, will be the budget. There is a lot more spending coming about, but we don't know the exact numbers. So until we see those exact numbers, we don't believe that the bond market will react towards higher yields, but we do foresee higher yields at year end. But right now, we think being in bonds is a good place to be, especially corporate bonds, because we're optimistic on the economy. And there's good yield to be made out there over and above inflation.
So, and then I guess let's frame it a little bit differently. Let's frame it through the lens of economic performance, because you just highlighted, and I would tend to, just looking at sentiment, it seems like short term, the big beautiful bill, spending can help an economy, and the stock market seems to be looking at that, regardless of the long-term deficit questions from that. But look, there have been moments this year when we've talked about recession risks, certainly for Canada as well. And it feels like, I have to be careful about what I say here, because it felt like the tariff story was improving, but then overnight, Washington is getting loud about, trade uncertainty again. But it felt like as the tariff threat seemed to lessen for Canada, that economists started to feel a little bit better about our economic performance. And then I guess if you take with that, fiscal is complicated for economies longer term, but in the short term, it's helpful. It feels like we're talking a little bit less about recessionary risks right now. and then maybe there's less urgency to be looking at fixed income as a result of that, despite the yields that you can get in the market, which makes sense for a lot of investors.
So there's three things to talk about. One is the economics, the economy. The other one's fiscal, and the other one's where does fixed income play in this. So from an economy perspective, one of the reasons why we're positive on the economy, optimistic, is because we're coming close to a tariff resolution in Canada. And all the comments that we're seeing coming out of the finance minister allude to those tariffs being fairly low, lower than most.
Yeah.
So why is that good for the economy? That's good for the economy because now businesses could start reinvesting in the economy, building plans, doing that because they understand the economics. If I spend $100, I'm going to make $10. Before you have certainty on tariffs, they're like, if I spend $100, am I going to make or lose? So now we're very close to getting that resolution. That's going to be a big boost in the arm for the Canadian economy. What's good about that boost for the arm of the Canadian economy, there's other aspects that are doing very well. We saw it in trade numbers yesterday. All our commodities. The world wants Canadian commodities. Gold selling to the UK. Oil to Asia and Singapore. Even pork to Japan was in that, aluminum to Italy, and that buoyed our international trade, not counting the US. So now you have that, now you have more clarity on domestic trade. That's really business owners start investing in the economy.
And I've heard people making the argument that one of the factors for gold's strength is the fact that if Canada's doing more production and selling more, then that generates more interest in the Canadian dollar for what it's worth. Okay, so I have two things I want to cover before we let you go. First of all, given what you're saying, where do interest rates fit into your analysis? Interest rate cuts, fit into your analysis for both Canada and the United States going forward?
Yeah, the base case is 50 basis point more of interest rate cuts.
For Canada.
For Canada, 25 in the U.S., and that's not because it's
for this year.
For this year.
Yeah.
So in Canada, the reason why we see 50 basis points possibly here is housing market, obviously. I think even though it's not an explicit mandate of the Bank of Canada to get housing going, there's a lot of issues in condos specifically. Housing market is flowing, but condos and new condos, and they need that to get rid of that backlog to start building more. That's an important aspect of the economy. We think that drives interest rates lower to bring up demand, condo demand.
And then real quickly, you always talk about the opportunities in the corporate bond market as well. I just wanted to mention for those who are looking for investment ideas, there are bonds tied to Capital Power, the Canadian-based generator, Cascade, the paper and packaging company as well. You think this is an environment where, like corporate bonds, if the economy is doing relatively well and yields on government fixed income are generally good, that there's even more bang for your buck potentially with some safe plays in corporates?
Yeah, 100%. We think this is a perfect environment for what we call a balanced portfolio. Equities and 60-40 as they call it, equities and corporate bonds. So those two companies, we're optimistic on them. They're considered high yield, which are riskier companies, not because of the business model, but because they have a high amount of debt. But they're able to cover that debt with their cash flows. We like the tailwinds of Capital Power, or Cascade will go first. We like the tailwinds there because it's tissue. They have a commitment to lowering leverage, and they have great cash flow.